Let's bring in the management. We've got N Vasudevan, who's the Managing Director and Chief Executive Officer of Equitas Small Finance Bank, joining in. Thank you so much, Mr. Vasudevan, for joining in. I want to ask about the bank's flagship product, which is the small business loans for FY23. This segment has seemingly done quite well in Q4 as well. What explains that, and what's the outlook for FY23?
So in FY22, we ended the year with a reasonably good set of numbers. The beginning of the year was impacted, but during the year things improved. And, we had last year, if you remember, we had guided for a 15% growth because of the wave 2 impact and all that. We ended up achieving exactly that at 15%. And credit cost, we had also guided a 2.5% credit cost for the year. And finally, the year ended with just about the same level of credit cost also. We had restructured about 9.5% of the book last year. And the whole focus of the bank was to see how that restructured book is going to perform. And a lot of focus on that. And finally, what's turned out at the end of the year is that the restructured book, some of them have become NPA by March, and so they have been recognized and provided for. And the remaining restructured book, we have set out the details in our presentation, if you had seen that. So we believe that there is no further significant stress coming from the restructured book, and the quality of asset is almost back to our pre-COVID levels, which gives us a lot of confidence or comfort to pursue growth. And in terms of guidance that you asked for in FY23, we should be looking at a 30% growth for the year in terms of our advances. And in terms of credit cost, our pre-COVID credit cost used to be in the range of 1.1 to 1.2%. Last year, as I mentioned, was 2.5%. But this year, into FY23, we expect our credit cost to be somewhere in the range of 1.5%. Trending closer to our pre-COVID levels.
Mr. Vasudevan, this is Vinny joining in as well in the conversation. I do want to know is, what's your take coming in on the NIMs? Where do you think it will be headed going forward, and what will be the impact of the rate hike on your financials?
See, if you look at our NIM, it's actually improved in Q4 compared to Q3. It's actually improved by about 50 basis points. And so the yield drop is something which has been happening over the last 4 or 5 years. As our cost of funds as well as operating cost keeps dropping, the yield will keep dropping over time. But our NIM, if you see, it's been more or less steady around the 8.5% level. It has been more or less steady over the last few years. So we believe that our NIM may be sustained in that same historical levels of around 8.5%. Because we are not doing much of a product mix change. We have now our portfolio consists of 18% microfinance, 45% small business loan, 25% commercial vehicle loans, 5% MSC loans, and 5% loan to NBFC. That product mix, we are not seeing any significant change in the current year. There will be some marginal changes, but not anything dramatic. Which means that my yield more or less may remain, my NIM may more or less remain similar. In terms of the rate hike that RBI has announced yesterday, we'll have to wait and watch how the market reacts to that. And if the deposit rates of other banks go up, then we may also follow suit. But we will be able to pass it on to the clients because, our ticket size, as you know, are very small loans. So a marginal increase in rate from an EMI perspective is not very high for a client, where the loan sizes are very small and tenors are generally short.
Mr. Vasudevan, talk to us about your asset quality. Provisions during the quarter were seemingly high at 1,200 crore rupees, but also take us through the upgrades, the recoveries, the write-offs and the slippages that you saw during the quarter.
So, we had a gross slippage of around 400 crores for the fourth quarter, out of which we have been able to recover. Our recovery as well as upgrades are very high compared to the previous quarters. And so our NPA did come down marginally from 4.39 to 4.06% for the fourth quarter. And if you look at the gross slippage of 400 crores for the quarter, a large part of it actually came out of the restructured book. And as I mentioned just a little while back, the restructured book minus the NPA, which has already come out of the restructured book, the remaining restructured book, the quality is pretty strong. And we don't expect too much of slippage coming out of the remaining restructured book. So going forward, we believe that the gross slippage should get back to our more normal levels. Pre-COVID, our gross slippage used to be in the range of around 150 crores to 200 crores a quarter. I think we should get back to those levels very, very soon.
And lastly, Mr. Vasudevan, what's the outlook coming in on the asset quality? Do you see it sustaining, the NPA numbers sustaining at these current levels for the coming quarters as well?
The quality of the book has significantly improved over the last 2 quarters, and the restructured book performance also has come back pretty well. The remaining book, which is a non-restructured book, has actually the performance is very much close to the pre-COVID levels on the rest of the book. So going forward, we should definitely see a downturn in our NPA.
So much for that, Mr. Vasudevan. Wish you all the best for the rest of the new financial year. We'll talk to you soon.